Hey everyone, welcome to Talk Tickers. So Newmont just dropped its Q4 earnings, and honestly, it's a real head-scratcher. I mean, the numbers were incredible, a total blowout by just about every measure you can think of. And yet, the stock went down. So what in the world is going on here? That's the paradox we're going to unpack today.
All right, here's how we're going to tackle this. First up, we'll look at that headline beat. Then, we'll get into the guidance disconnect. That's the key part. After that, we'll see how this created a tale of two completely different stories. And finally, we'll wrap it up with our take on the next call.
So first things first, let's talk about the quarter itself. And wow, looking at the Q4 numbers in a vacuum, it was just an absolute home run. I mean, we're not talking about just good results here. This was a massive beat on every important metric. It really looked like Newmont was firing on all cylinders.
Okay, let's start with the bottom line, right? Earnings per share. They posted an adjusted EPS of $2.52. Now, to put that in perspective, Wall Street was looking for something around $2.05. So yeah, they didn't just beat expectations, they absolutely crushed them.
And it wasn't just earnings. The top line, the revenue, was just as impressive. We're talking $6.82 billion. That's over $600 million more than what the street was projecting. A big part of that, of course, was a super strong gold price. They realized over $2,000 an ounce.
And here's the number that really tells the story management wanted to tell: cash. For the full year, they generated a record $7.3 billion in free cash flow. This was their big talking point, you know? They kept coming back to it to show how disciplined and financially strong the company is.
So, this is the big question, right? You see a blowout quarter like this, record cash flow, earnings crushed, you'd think the stock would pop. But nope, it actually fell about 3.5%. What gives? Where is the disconnect?
Well, the answer, as it so often is, isn't about what just happened. It's about what's coming next. It seems like the market pretty much ignored all those great Q4 numbers and focused like a laser on the company's guidance for 2026. And, well, they did not like what they saw.
This right here, this is the whole problem in a nutshell. You've got 2025's reality versus the 2026 outlook. Look at this. Production is expected to drop from almost 5.9 million ounces of gold down to about 5.3 million. And at the same time, the cost to get that gold out of the ground, the all-in sustaining cost, is set to jump. A big jump. From around $13.58 an ounce to almost $1,700. Ouch.
And this chart just makes it crystal clear, doesn't it? That's a very obvious step down in production that the market is now having to price in. And for investors who are always looking for growth, seeing a forecast for fewer ounces, well, that's a really tough pill to swallow, no matter how fantastic the last quarter was.
Okay, so what's the reason for this weaker outlook? Well, management's explanation is that 2026 is basically a planned rebuilding year, or a trough year, as they call it. They're pouring a ton of money back into the business. We're talking over $3 billion in capital. The whole idea is, hey, let's spend big now on our mines and projects to set ourselves up for a big return to growth starting in 2027.
And this is where you get this split, this tale of two totally different stories. You've got management's version, which is all about cash flow and financial strength, and then you have the market's version, which is all about what's coming down the pipe, those future ounces and the risks involved.
Right, so on the earnings call, management was basically pointing to the scoreboard. Look at our record cash flow. Look at the $3.4 billion we gave back to shareholders. Our balance sheet is solid. But investors, they're not driving by looking in the rearview mirror. They were looking straight ahead, at the road, and they saw warning signs. Production is going down, costs are going up, and there's a lot of risk tied to all this spending.
And this reaction from the analysts at BMO really sums it all up perfectly. These guys are still pretty bullish on the stock, right? They kept their outperform rating, but even they had to pump the brakes a little, trimming their price target from 145 down to 140. It's basically their way of saying, yeah, that was a fantastic quarter, but guys, the next year is going to be a grind.
Okay, so let's put it all together. What's the bottom line for Newmont from here? This is the next call, our take on what's ahead.
For the next quarter, Q1 2026, we're not expecting any big surprises. The results should be pretty much in line with the guidance they've laid out. As always, the stock price is going to be tied to what gold does. But the real thing to watch, the key focus for everyone, is going to be any commentary on cost control. Honestly, until the market believes that Newmont has a handle on costs and their big projects are on track, that weak full-year guidance is probably going to act as a ceiling, keeping the stock from really taking off.
So with all that in mind, our rating is market perform. It just perfectly reflects that push and pull we've been talking about this whole time. On one hand, you have this incredibly strong financial position and a commitment to shareholder returns, but on the other hand, you have these very real challenges ahead in 2026 with costs and production. It's a balancing act.
So if you're looking for a specific trade idea, here's one to think about. The thesis is that Newmont's discipline and financial strength should help it perform better than its competitors, especially when costs are rising for everyone. So the trade is a pairs trade. You'd go long Newmont, but short the gold miners ETF, GDX. The whole point of this is to bet on Newmont's relative strength against the rest of the sector, kind of hedging out the broader industry risks.
And of course, we have to end with this reminder. All of this is just for informational purposes. This is not financial advice. Please make sure you do your own homework before making any kind of investment decision.